as we transition into cycles, there's going to be a lot of volatility and most likely some severe drawdowns defined as peak to trough losses.
Which is what people are terrified of. I mean, especially, and if that happens in the early stages of someone's retirement,
I got the numbers here. I got the numbers here.
You want? Go for it.
So if you ask the smartest people in the world, these are people that know Fed policy, economic history like the back of their hand. But you know what keeps them up at night? Is that if you're 65 today and you just recently retired, if you have a 20% loss in your portfolio in the first 3 years of retirement, on average, it takes off 9 years of spending power of your plan.
Wow.
So if you're planning for a 30-year retirement, you just ran out of money in year 21.
Wow.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber, founder and CEO of Barber Financial Group. Have you ever thought how great it would be to be able to get into the brain of money managers managing hundreds of billions of dollars, of how they look at the economy, how they choose good companies over bad companies, how they make their decisions on what to buy and what to sell and when to own what, and how they look at the overall economic activity? Well, today, we're going to hear from David Mitchell with AllianceBernstein, and they do manage over $500 billion worldwide for thousands of individuals, corporations, endowment funds, etc. We're going to get into the details of how they look at the economy as a whole, how they make decisions on what they buy and sell. The idea here is for you to hear from people who do what a lot of us rely on, and that is managing money. I hope you enjoy today's program with David Mitchell here on the Guided Retirement Show. So we've got David Mitchell with us today on the Guided Retirement Show. David is 14 years with AllianceBernstein, and I'm not going to butcher the whole introduction here, David. So tell us a little bit about AllianceBernstein, what you do for AllianceBernstein, and then we'll kind of set the stage for what you and I want to talk about today.
Thanks, Dean. So AllianceBernstein is a global money manager based in the U.S. in both New York City and Nashville. We currently manage just around $580 billion worldwide, and our clients run the gamut. So we have individual families here in the U.S. We have intermediaries like yourself or financial advisors that entrust their clients' assets with us. We also have a large institutional presence. So endowments, foundations, global sovereign wealth funds, you name it, corporate retirement plans. So really every single type of entity you could imagine entrusts assets with us. And we do it, we're not known for any one specific type of asset class or security. We have bonds, stocks, alternative assets, real estate, so you name it. So we really have a very diversified offering as far as our products.
Well, with $567 billion in assets under management, I would assume that you all have tons of research analysts, economic experts, and the like that are driving information to the portfolio managers. But then you'd also take that information and pass that information to people like me that I can pass it out to the general public. And so the Guided Retirement Show here is a great format for you and I to be able to talk about economic cycles and the psychology of investing and what people need to know. And so I'd like to get into a discussion with you about, let's just talk about economic cycles. As we record this episode of the Guided Retirement Show, we're here August the 6th of 2019. 2019 so far has been a pretty good year. The last week or so has brought a lot of volatility. But I think that what happens, David, is that people get so caught up in the moment of the latest soundbite or the tweet or whatever it is of the day or the minute, and they start making financial decisions based on news. And the reality is that our economic cycles are much broader than that, and they're almost immune over a longer period from the day-to-day news. But yet people make decisions, and most of the time the wrong decisions, based on immediate news. So let's talk about, just give us a basic overview of economic cycles. What should people understand about economic cycles?
So I'll say a couple things about that. When we talk about economic cycles, AllianceBernstein, we think about it in two different ways. A majority of our industry thinks about the typical, they might say the business cycle, They might think of an economic cycle as a bull market in stocks or financial assets. You typically see that cycle if you go back and study financial history over the past 100 years, 5 to 10 years. And so stop me if you've heard this before, but most pundits out there and talking heads, us included, think that we're later cycle or later innings in the current economic cycle or bull market. But anyone who's been to a Royals game will tell you if you're late innings, you can always go to extra innings as well. And I'm sure we'll talk about maybe some reasons for that. So, but we also think about it in terms of longer super cycles. And often in just my conversations with clients here across the upper Midwest, I find that a lot of people miss the forest through the trees, where they want to talk about, to your point, today's news, today's tweet, today's controversy or sensational journalism, when they also aren't thinking about broader trends that are structural, like population growth and demographics, like automation or globalization. Those are the things that really matter if you're investing for 10 or 15 or 20 years, which most of your clients are.
So a good example of that might be the invention of the internal combustion engine.
Absolutely.
Right? And so that created a long-term, growth cycle in what was referred to as the Industrial Revolution.
Yeah.
Right? And then we got to the advent of the internet and the technology and the cell phones, and we've been living through a technological revolution, and those kind of super cycles like you're talking about, those things by themselves can drive economies and markets for decades. Not that it's straight up, because you're going to have short periods of time when things don't look so good. You kind of went too far one direction. Markets got to come back. Economy's got to come back. Slow things down a little bit, but then it continues on. So, are you saying right now that AllianceBernstein believes that we're in the late stages of a super cycle?
We are. So both types of cycles. We think that we're later stages in this current traditional business cycle. And there's various indicators, mainly around labor, that we're looking at in the workforce that are kind of starting to indicate, labor growth is slowing because we're almost at maximum employment.
Well, there's more job openings today than there are people
in many
that
sectors,
are looking.
That's absolutely true. The underemployment rate has come down to, I think, 7%, which is the lowest, again, it's been in a generation. So a lot of this, like you said, is natural.
But I think people think that if we're at a very low unemployment rate, that's a good thing. And while it feels good, it is good. But the reality is, all right, how are we going to get additional consumer spending? We can't do it just because we've got full employment, because we're not going to put more people to work. They're going to have more money to spend.
Yeah,
and
that's a great point.
We virtually had, no inflation to speak of over the last couple of decades, and so we haven't seen much wage inflation.
That's right.
And so, is that what you're saying? Is that we're at a point where if unemployment starts to go the other direction, the consumer, who's 70% of our gross domestic product, they're not going to be able to bail us out?
So the consumer is a great point. And let me take a step back here and think about, because we throw out these numbers and these acronyms in our business, Dean, like GDP, right? Assuming that everyone knows what makes up GDP. And when I explain this to people that don't do this for a living, I say, think about GDP, and it's reported on every day, as people and productivity. So Bob has his hammer, and how well does Bob swing his hammer, right? And to your point earlier about these super cycles and about the current cycle, one thing that's different now, and this gets into your conversation about the consumer, in 1981, which we've done a lot of research around these huge events, really this cocktail of events, about 5 to 10 things that happened right around 1981. One was the oldest baby boomer turned 35 in 1981. And they didn't know it, but they were about to enter a 20-year cycle where you had really the birth of globalization, right? Deng Xiaoping, the premier of China, 40 years ago gives his 4 pillars of modernization speech, effectively making China the world's factory floor, right? You said the digital age, right? You have in 1983, the birth of the internet with Microsoft Office. Really, again, that really was the catalyst for this new informational age that we now currently sit in. So all these things kind of happened together in 1981. Now, fast forward 40 years later, that boomer that turned 35 in 1981, the oldest one's now 75. A majority are 65 to 70 are staring at or in retirement. So once you get into retirement, your consumption patterns change
dramatically.
So demographics that we do so much study, it was a huge tailwind for 20 years. And it's why, by the way, a lot of people forget this. From 1981 to 2000, you had a 20-year period where the S&P, on average, for 20 years, did 17.2% a year for 20 years.
Well, and I think everybody thought as you entered into the year 2000 that was just the new normal. That's just what it's going to be.
Absolutely.
Okay, let me back up because you missed one huge piece that drove the economy from the early 80s. All right, it was the advent of revolving credit.
That too.
All right, so and the baby boomers were the first generation where you had two people working in the same household.
Increasingly.
Okay,
Yeah.
and so you had both husband and wife working. People were borrowing money like crazy.
And think about why, real quick. This is the last part of the cocktail I missed. You had what we call the Paul Volcker mountaintops and rates. So that baby boomer didn't know it. They were about to enter a 20-year period where inflation and interest rates. I mean, think about
we're going to decline.
Think about the first mortgage you took out in 1979 or 1980. What, 15%?
Right.
So they didn't know it. So not only did they have this massive tailwind, at their back of real wage gains, productivity enhancements, all these good things happening around globalization and automation, but they also had now cheaper financing, right, and cheaper interest rates. So to your point about the access to credit and cheap credit, ultimately we saw excesses do built up.
Right, they did, and that everything came crashing down then
twice in a decade.
Yeah, absolutely.
Right, in the dot-com bubble in the early 2000s, and then again in the housing crisis and housing bubble in the mid 2000s.
Yeah. So there were a lot of things, but most of these super cycles that you reference last on average about 40 years.
Yes.
Right?
Yes. That's about right.
So that's why you're saying we're probably in the late stages of this super cycle because it really began in earnest in the early 1980s. I mean, you could so go back and look at economies and markets. I mean, you could have gone from the mid 60s to 1981, a 15-year period, and you had effectively zero return in the broad markets over that period of time.
It wasn't very. And then you also had what we call the lost decade between 2000 and 2010, which is part of this 40-year cycle. But the average return of the S&P for that 10 years was negative 5%.
Right.
So yeah, again,
you went from a 20-year period with average of over 17 to the next 10 years was minus 5.
And by the way, to tie back to where we are today, I don't think coincidentally, but since the market bottomed in March 2009 to really until 2018 last year, another 10 years, 17% a year again. So you went 17% for 20, you did negative 5 for 10, and then you've had the last preceding 17% again.
Yeah. So what's that mean? What does that put us today?
So that puts us in a world that we look at today with all these different macro trends, these thematic, these structural trends. That AllianceBernstein's view is if you think about investing for the next 5 or 10 years, which again we try to get people to do. In your seat, Dean, I know it's easier for me to think about because I deal with professionals mostly day to day, but you deal with the public every day. And now trying to get people to have a time horizon more than a month or 2 or 3 can be challenging because again the 24-hour news cycle and all these things. But to tie it back to AllianceBernstein's view, we think all of these events and all of these fundamentals put us in a world where the next 5 years, we get about 5 to 6% growth, average return in the stock market. And how do we get that? It's just math. You get about your dividends of 2%, you get inflation of about 2%, and you get real GDP growth of about 2%, give or take 6%, right?
Yeah.
5 to 6. And so, but with the caveat, as you were alluding to earlier, that as we transition into cycles, there's going to be a lot of volatility and most likely some severe drawdowns defined as peak to trough losses.
Which is what people are terrified of. I mean, especially, and if that happens in the early stages of someone's retirement,
I got the numbers here. I got the numbers here.
Go for it.
So this is what, if you want to ask the thought leaders, because I am the lowly consultant in the Midwest, right? But we have analysts and portfolio managers in 40 cities across the world, 19 countries. Again, a lot of our intellectual thought leaders are based in New York. If you ask the smartest people in the world, any of these are people that know Fed policy, economic history like the back of their hand. But you know what keeps them up at night? Is that the average person if you're 65 today and you just recently retired, if you have a 20% loss in your portfolio in the first 3 years of retirement, on average, it takes off 9 years of spending power of your plan.
Wow.
So if you're planning for a 30-year retirement, you just ran out of money in year 21.
Wow.
That is the mathematical.
Well, I would challenge that thought, though, right?
Please.
I mean, I've worked in this industry helping people get to and through retirement for, over 3 decades.
Yeah.
Those people won't run out of money, David. And you know why they won't? Because they'll live like they're broke. They will reduce their lifestyle. They will spend less. They will do less. They will forego things that they really wanted in an effort to make sure that they hold on to that money. Because the last thing they want to do is be reliant upon either their children or the government, right?
In that your world, this is just the math that if you kept the same spending,
right,
as your, and that's about 4%. But
I know what you're saying.
You're right.
But people that are frugal with their money and are able to accumulate and save, they don't go broke, but they'll live like they're broke. And that's not the ideal retirement. That's not what somebody wants. And that's why we're doing the guided retirement show. Is because what we're talking about here is the longest vacation that people are ever going to take, and that's their retirement. Well, you don't go on an amazing vacation and not hire a guide to show you all the things that you want to see, especially if you're going someplace you've never been before. Well, retirement, you've never been there before.
That's right.
You need some expertise and some help of doing that. So, all right, so back up here and let's talk about how people can prepare themselves for the end of this super cycle. What should they be thinking of? What should they be doing? How should they be stress testing what they've got? And is it okay just to stress test the investment, or do you have to understand how that investment fits into your overall retirement plan?
Yes to all of the above, right? So what we would say is we do stress test portfolios, and a lot of times it's people in your seat that generously share with us what they're doing in your chair and say, do I have any blind spots I'm missing here? But the thing is that, yes, if you do have it, and it's very feasible, we can have a 20% loss in the markets over the next 3, 5, 10 years. Well, I don't know when, and I don't know what the catalyst will be, but it's very possible.
Or more.
Absolutely, or more.
I mean,
and 20%, I'm talking about people that have maybe 30 or 40% in bonds, so 20% in that personal portfolio, which would mean the stock market's down even more, to your point.
Well, a 60-40 portfolio in the 2008 financial crisis would have had a drawdown of 32% from peak to trough.
That's right.
Right?
That's right.
So that's somebody that only had 60% of the money in the stock market and 40% in bonds. So I think this idea that diversification is your only protection mechanism is crazy, and that active management of your money is no longer needed, that you should just own an index or something like that. And I think that notion is crazy. Now, there are times when the passive style of investing works well, and especially in bull markets. I mean, and when it's kind of the old saying, the rising tide lifts all boats, right? But it's not until the tide goes out that you see who's swimming naked. Well, you don't want to get caught in a tide that's going out and go, okay, wow, I didn't think of these things.
Right. And let me back into what you just said and tied into today, because this is what I think as you're doing stress tests, people really have to account for. And that's the reason you had balanced portfolios and balanced mutual funds or balanced ETFs in 2008 that were down 25, 30, 35%, almost in line with the market, is because the most powerful tool that we can build in the asset management business is what I call a barbell, which means you have assets on which is what a balanced fund is supposed to do. So so think about it this way: stocks and bonds. The problem comes in when people start to get too cute with one or the other, and where they try to get too cute was on the bond side. So because you could buy higher yielding bonds in certain asset classes or certain types of bonds, whether they were housing-related bonds, mortgage-backed bonds, other types of corporate bonds. Now you have emerging market debt and all these sort of esoteric sectors. People forget that there's
risk in those.
There's risk in those, right? And I often say they are not a first cousin to a U.S. Treasury. They are more a proxy for stocks. And so even today, with the 10-year Treasury yielding 1.75.
Well, now, no, 1.6 the day that we're recording this. It dropped by 15 basis points in the last 24 hours.
There you go, how fast, how much the daily news cycle can drive day-to-day performance. So that doesn't feel great, But here's what we know. You have to still have a portion of your assets in truly reliable risk mitigating assets. And even though today those assets don't pay you a lot, what we found out is that whether it was the fourth quarter in 2018 when the market went down 13%, treasuries, AAA muni bonds, certain safe haven currencies like the dollar, they rise in value when people collectively say, oh no, and start indiscriminately selling their ETFs or their funds or their individual stocks as they just say, I don't want to be in the game right this. I think this is going to be a bad event. For the last 10 years, that event has been very short-lived because we've had these drawdowns and these V-shaped recoveries.
Right.
But you have to have at least some of your, and so when you do these stress tests, usually we find the problems exist on the bond side of the equation, not the stock side. And it's people taking too much risk in their bonds that too often correlate to stocks, especially when you have severe risk in the markets that is driving down stocks.
Okay, I would buy that, but don't you think there's also too much of a concentration risk on the types of stocks that people will own because they're buying these ETFs that are designed to mirror an index, and they don't really understand what's backing
Maybe
it?
I could come back for a whole half hour and we could discuss that, but you're exactly right. So what people ask me what's different today, even from 2008, what's different today? You have, on average, if you just look at daily volume of the New York Stock Exchange and most major indices in the world, a vast majority of it is not individual mom and pop and even Dean Barbers of the world out there picking stocks for their clients. It is quantitative, high-frequency trading, algorithmic, very sort of... There are tools that are in place that really aren't designed to manage money for the long term, that are strictly out there trying to make money day to day, that force these markets to have these wild gyrations, right? So ETFs, I think have served a lot of good purpose as far as lowering costs and transparency. But the derivative of now you have so much money piling into ETFs, right? If you're tracking an index, right now, the S&P, right, there's like 6 stocks that make up a quarter of the S&P. So if you're buying an index that tracks the S&P, you don't know it. But your concentration in those 6 stocks, and you might also have a tech ETF in your portfolio. Now, all of a sudden, a 30-year portfolio is in 6 stocks that tend to actually all correlate with one another, don't have a lot of really nuanced differences about them. There is a lot of concentration. It's unintended content. It's not like someone saying, I just want to go out and own, I worked at IBM for 40 years, so I want to own IBM stock like it used to be. Right.
So we talked about this in season 1 of the Guided Retirement Show. It's episode 12 and episode 13 where we go into the difference between mutual funds and ETFs. And I encourage you to go back if you haven't listened to those 2 episodes of the Guided Retirement Show. Go back and listen to those, because when you talk about these ETFs, you've got the ones that are equal weight ETFs, and then you got the ones that are weighted based on market capitalization, right? And so what you're talking about is the ones that are based on market capitalization,
which represent a lion's share of the assets.
I understand that, but what my point is that people don't understand the difference between those different types of ETFs, and they just think, well, Vanguard's got one, or iShares has one, or whatever it is. So I'm just going to buy
this
that
one's cheaper
ETF.
than that one, so this cheap is better.
And they don't understand that they're not the same. And they'll suffer different in market declines. They'll perform different in market advances. And it's not like you can say this one's going to do better over the next 5 years, the next 10 years, but you need to understand the difference. Because if you don't, what happens is you get this huge concentration. Let's go back to the dot-com bubble, right? So the S&P 500 was over 30% weighted technology.
That's right.
Right? And when the tech bubble burst, people weren't thinking, well, these big, bellwether 500 largest companies shouldn't really suffer. Well, sorry, but a third of the S&P 500 was made up of technology companies at that point in time. That's why the Dow, the top 30, the biggest 30 companies, didn't suffer nearly like that because the Dow Jones Industrial Average wasn't laden with technology companies. And so, again, I think my point what I wanted to take people to is that when you build that portfolio, it's not okay to just say, well, I've got a 60-40 blend, or I've got a 50-50 blend, or I've got a balanced fund. What the heck is in it?
That's right.
And that's where the psyche of the individual investor gets messed up, because they don't understand what's in it. They don't understand why it's doing what it's doing. They don't understand the economic issues that are going on. and they make bad decisions because they make those decisions based on emotion and the news of the day. So the big question is, how do you get people to avoid that? To me, that's my challenge every single day. And I think that what we're trying to do here on the Guided Retirement Show is to provide some education so that people are more informed of what's really going on out there so that they can take that longer term view. And I'm not just saying, buy and hold and hope either,
right,
but understand what you own and understand how these different asset classes will perform in poor economic cycles or poor market cycles.
That's exactly right. In listening to you, you talk about the value that you provide to clients, I'm reminded of a quote, and I hope I don't butcher it, as it's been a while. But I think it's as relevant today as it's ever been. Because and you correct me if I'm wrong, but I still think we're 10 years away from 08. I think a lot of the scar tissue has started to heal. I sense some greed coming back. I mean, I know people that have
for sure.
I have heard from folks like you that clients that have been up, clients in retirement that have had 10% returns aren't happy,
right? Because
the market, which according is the new arbitrary benchmark,
which it should never be.
It should never be, right? Did 20, right? And so there's some greed. I don't think we're at the euphoria stage yet, but there's definitely some greed seeping back into the psyche of the typical investor. The quote I'm going to come back into, it was something that was taught to me 14 years ago when I first started at AllianceBernstein. I've never forgot it. In the absence of knowing what's enough, the alternative is always wanting more. And I feel like a lot of people, the biggest mistake they make is they don't know what's enough.
Okay. All right. So I'm glad you brought that up because here's how you identify that, right? And that's all. Our guided retirement system is designed to identify what's enough, especially when it comes to asset allocation. So we go through the whole guided retirement system. We build out what people want their ideal retirement to look like. And then we say, based on the resources that you have, us helping to minimize taxes, maximize Social Security, all the things that go into a great retirement plan, a 30% equity, 70% fixed income is your best option. That's the one that gets you safely through retirement with the least amount of volatility. Or it might turn around and say, you know what? You don't quite have enough, and in order to make it work, you need 80% equities and only 20% fixed income. And what have you done? You've greatly increased the risk of a drawdown. You've greatly increased the risk of that, early stage retirement drawdown. And so you might want to step back and say, gosh, okay, I maybe want to work a few more years so that when I walk into retirement, I'm not doing it forced to have 80% of my money in stocks in order to make it work.
Yeah.
But yes, being able to actually see that, I always ask it this way, what's the least amount of risk that I can take and still achieve my objectives?
Yeah.
And if you can't quantify it, you're right. People are just going to go out and want more, and they're going to want to compare what's going on to their neighbors or the stock market or whatever. And really, I think you should have what's called your own retirement index, your PRI, your personal retirement index.
Love it.
That's the return that you need to focus on. But in order to identify what that return is, it takes a lot of financial planning, and it takes a lot of counsel work with a good financial planner to be able to identify that personal retirement index. That's all you should benchmark against. You shouldn't benchmark against some arbitrary, index, and you shouldn't. For sure, don't benchmark against your neighbor or a coworker or relative, right?
Because you really don't know their true circumstances.
They're never going to tell you about their losers.
Right, that's right. Yeah, that's exactly right.
So let's change gears here just a little bit. I think what we just did was pretty enlightening for our listeners. Let's talk about the cycles of expansion and contraction. And I want to challenge your notion that we're at the end of the 40-year super cycle. I think this one's going to be a 50-year super cycle, and here's why.
Like I said, we can always go extra innings.
I understand, but here's why I think it is, right? You mentioned the baby boomer generation, all right? Well, we now have the millennial generation, right? And many people don't give the millennials credit for anything, right? But the millennial generation is actually 2 million people larger than the baby boomer generation.
I'm the oldest one, by the way.
Right, you are. And so what's happening is, think about this and think about the people that are 10 to 15 years younger than you, David. They don't start family formations in their 20s. By and large, they're living in apartments. They're living with mom and dad. they're living it up, they're having fun, but they're not interested yet in starting a family. And so the baby boom generation started their families in their 20s.
Right.
The millennial generation isn't starting their families until they get into their 30s, and sometimes it's into their mid 30s, right? Well, okay, so let's say now we got 2 million more millennials than we had baby boomers that are just now in the last few years starting in their family formation years. Okay, you have young kids.
Yes.
All right, so you're spending more money today than you were 10 years ago, and it's not on you because kids are expensive. When that 78 million millennials start having babies and buying houses and furnishing the houses and all the things that are going on, I think we're going to have a 10-year tailwind of that millennial generation moving into their family formation years. So that's my argument for a demographic tailwind with the millennials.
I would say that there is some merit to that, in that the millennials have delayed a lot of traditional consumption patterns relative to older generations. When we talk about demographics, though, we're simply talking about birth replacement rates. And the one thing we know, so I have one daughter. My mother comes from a family of 5. So the other thing too, millennials are having fewer kids. Granted, there's more of them, and so could there be some delayed spending there? Absolutely. But I think we also are missing another point that is another structural issue. And I sometimes hesitate even going there, because often I think there's a politicalization to this comment that's just a fact that we have to deal with. But now 1% of the population controls 31% of U.S. household net worth. 1% controls 31%. 50% control 1%. And so in some ways, I want to tie this back into because you and I think day to day, we meet with a lot of people that the millionaire next door types. We meet with people that worked for a company for 20 or 30 years, a great local company, had a good retirement program, had some deferred compensation, and did it the right way. But half of the country, again, has basically been living paycheck to paycheck and can't afford a $400 car payment. So that's another issue when we're just looking at kind of some of these structural issues that tells us that if we're relying on just the consumer, we better hope that 1%, and what we know that 1% are more vulnerable, because now and 10% own 83% of outstanding stock value, 10% of the population. So we are much more of a top-heavy society than we might have been in the 50s, 60s, or 70s.
I would agree with that.
That's kind of sort of the other sort of counterweight to that. And I know, and I am not a politician. I am not a policy person. So I have some ideas as far as the prescriptions, but it's not my day job. But those are problems that we're going to have to be forced to deal with at some point in time to ensure more people are able to spend by not borrowing, to tie it back to, because what led to the housing crisis were people
too much
using their homes as piggy banks.
Right.
And so a question is, for a lot of half the country, how are they going to afford what we might see as necessities, other people might define as luxuries, those vacations, what have you. But a lot of people simply can't afford them paycheck to paycheck.
I would agree with that, but I also think we've always had that divide. And think about this. Okay, so wealthy people naturally want to accumulate money, right? The people that don't have a lot of money, they want to accumulate stuff, right? So I think there's choices that people make that might put them in that same situation. I've met a lot of people that have saved a lot of money and never really made a whole lot, but they were frugal. Because they understood. They created very early on a long-term plan. And I hope that what we do here with the Guided Retirement Show is we impress upon people the need for them to do some things on their own. Because when you say that somebody can't afford a $400 car payment, yet they have 2 cell phones and 4 big screen TVs and, are paying $2,000 a month to rent a nice apartment in the popular place in town, what are the priorities? Where are the choices, right? Are they saving first? Are they paying themselves? And I think that our society has become, I call it a drive-through mentality society, where I want what I want. I want it now. I want it cheap. I want it easy, right? And I definitely don't want to wait on it. The whole thought of delayed gratification is something that doesn't exist in the vast majority of our country today. But people need to understand that, the government's not there to support you, right? You've got to do something for yourself. And in order to make make sure that you can have that good retirement that you want to and not always have to work for somebody, you got to start saving. And you got to have, and there's trade-offs, man. You and I have both made trade-offs our entire lives. We can't have everything we want all the time.
Yeah, I mean, like I said, in some ways, we're seeing that millennials value and spend more of their money on experiences versus things. So,
absolutely,
right. So, but tie all this kind of back into where we're coming from is that what are the tailwinds that get So I'll put it this way to you, Dean. Like I said earlier, our 5-year forecast for this is called the S&P 500 or the broad market is call it 5 to 6% a year for the next. Again, not great, not terrible, but kind of mediocre at best.
But again, that doesn't come in a straight line.
That does not come in a straight. Actually, that's not 5% a year. That could be all over the place.
You could have a 30 or 40% decline and then come back out of that trough and still average that 4 or 5%.
That's right. What we are trying to figure out as a firm, and I think this is where you're healthily pushing, maybe challenging us a bit, is that what would change to get us to a 9 to 10% return a year? Because I go back to what drives. I mean, and I don't want to wonk out here with you, but what drives earnings historically? What drives GDP, get people productivity, earnings are typically driven by top line growth. It's been all margin expansion and share count reduction, which again, I don't want to get too technical here, but it hasn't been fundamentals that have really driven the market over the last 2 years.
No, I've in the last few years, I've said just take the fundamentals and throw them out the door. And if you're going to invest based on fundamentals, that you
better have a longer time horizon.
You just
than you
look
used to.
dumb, right? When you're not, because at the end of the day, fundamentals 100% of the time will come back and drive the market.
It's just a matter of when,
right?
And what the reason is for that. But tie this into the Dalbar study because we've been hitting. I mean, Dalbar is a third-party research firm that it really came up prominent several years ago when they did a study. This may be 10, 12 years ago, that said it was a certain time frame. I think the preceding 20 years, the S&P had done 10 or 12% a year for 20 years, from the early 90s or maybe from 88 to 2008, 2007, and the average investor.
2.9.
Yeah. 2.9. All because of what you're talking about, of the short-termism that we deal with, of letting the daily news cycle drive theirs. I mean, Dean, how many times has someone called you and you've even done the work with them, perhaps, right? I'm sure more people.
And they still get but they still get emotional.
But they still get emotional, and we can table this conversation for the whole of how social media has changed things, how 24-hour cable news has changed from 20, 30 years ago, But that's the difference here of all we're talking about is that how do we get people to at least participate in a okay market, but also defend against a lot of potential downside risks out there.
So here's what happens, and I'm going to relate this back to our guided retirement system. All right, you and your wife, you hop in a car, and you plug into your GPS the location that you're going, and you know what happens? The minute you back out of your driveway, what that GPS told you is wrong because things are going to happen. There's going to be a traffic jam. There's going to be a detour. Something's going to come up. You're going to have to stop and go to the restroom. Maybe you're going to stop and get a bite to eat. But you have comfort in knowing that when you get back into the car or when you look at that GPS, it tells you, you know what? Yeah, you're going to be 10 minutes later than what you thought you were going to be, but everything's still okay. And because you know, you don't panic, okay? Now, imagine that the GPS didn't exist, and you or a wife get in the car, and there's a detour in a major city that you've never been in before. And now you're in a part of town that you don't recognize, you don't have GPS, you don't have a smartphone that you can reroute yourself to. You're going to rely on one of those old Rand McNally atlases, right? And David Mitchell is not going to stop and ask for directions, but your wife's going to be hounding you, just pull over and I'll ask for directions. No, I'm not going to ask for directions.
I got this.
Okay. Yeah. And so there's going to be conflicts going to set in, panic's going to set in. Why? Because you don't know. A good guided retirement system lets you know every day where you are on your path to what is important to you. If you have that in place, you can ignore all the noise of the in-your-face 24-hour media and just say, you know what? I'm still on the right track. Yeah, okay, the market was down a few hundred points. I'm still on track. Look, here's my score. Okay, maybe I have to work 1 year longer. You know what? Maybe I have to spend $5,000 a year less, but I'm still going to retire at that date.
Right.
But you know that, right? And what
You're in
happens is
control.
You are in control.
You're in control.
You have
and you're not-
clarity.
Yep. You're not just throwing your hands up and saying,
Right.
I have no clue what to do next.
Right. So you have the three things: clarity, delivers confidence, because you know you're in control. That's what GPS does. That's what our guided retirement system does.
And think about what a way to avoid your clients or any clients out there becoming one of those statistics in that Dalbar study, the people that get 3% return when the markets broadly, if you just stayed invested, give you 10 or 12. Once you have these conversations with folks, and the term I've always used is they're able to pre-experience what some of these detours might look like, what that stress test or downturn might look like. All of a sudden, that performance conversation, if I only did 10% last year, Dean, and the market did 15, what gives? That all goes away because the performance is beholden to the portfolio construction, which is beholden to the plan, which is beholden to them knowing what's enough.
Bingo. And then you bring that back to the fact that we have economic expansions, we have economic contractions. It's very normal, right? This is just economic cycles. We have market cycles, expansions and contractions. And then we have the super cycles that you talked about. So I want to wrap this up, but before we do, I want you to go, and you may have this statistic, and if you don't, that's fine. We'll just.
I promise I won't make it up.
Okay, so the last super cycle that was a super cycle that was negative. So you're going to say we're going to go into a 40 or so year super cycle of great things, and then a 40-year super cycle of, it's okay, but it's not great. Is that what you're saying?
Well,
those super cycles go both ways.
Well, rarely, if you're looking in modern financial history, rarely have you had a 40-year super cycle of things being below subpar.
So those are 10 to 15.
You have these like you said, you have these periods within cycles that you may go on pause for a long time. Or have to reset values because of a bubble bursting in the financial economy, which causes a recession and values to reset. And this kind of flushing out of the market. That's what you tend to happen.
It's interesting though is I love what our industry does. Actually, I said that tongue in cheek. I hate it. What people will point out is if you invested all your money in the stock market on March 9th of 2009,
right,
you would have made this. Well, I'm going to tell you that there isn't not one person that I know that would have had the nerve to put 100% of their money in the stock market on March 9th of 2009 after they just witnessed it falling over 50% in the prior 15 months. Nobody would have done it.
Show me that person.
Nobody wanted anything
to
do with it.
I want to shake their hands. Yeah.
Right. And then you come in a couple of years later and you got the shut down on the quantitative easing, and then they start buying the bonds back. And so all the quantitative tightening and all these things freak the markets out in short periods of time. But if you understand what you own, why you own it, and how it fits into your overall financial plan, and you've got that GPS in place that tells you, you're still on track.
That's right.
You're still in good shape. Don't worry about it. Just keep doing what you're doing. It's okay. It gets you that confidence and that clarity and that control that we talked about.
That's right. And it comes down to that. That's all we pre-experience by being able to know that we're in control.
Yeah.
And like I said, there's going to be a lot of noise. There's going to be a lot of volatility, fancy word for uncertainty, and market gyrations. But if you have that plan and you've had these tough conversations, these conversations aren't easy, Dean, as you know. And people, it's like going to the doctor in some ways and getting a diet. You don't want to know that your cholesterol's high. You might have a little high blood pressure, but you need to know.
Absolutely.
And so,
because when you know, you can actually do something about it. You make a conscious choice, then I'm not going to do anything. I'm okay with what I see, or I better make some changes.
Yeah. And how many clients they just simply haven't had a physical in 5 years or 10 years.
Well,
and then all of a sudden they don't start feeling very well, and like, well, I better go. And then it's hopefully not too late, but it's like, well, I should have been doing this 5 years ago. I should have been on Lipitor or something 5 years ago.
Right. Well, listen, this was interesting. I hope everybody that's listened to this episode of the Guided Retirement Show has learned something here. David Mitchell, AllianceBernstein. We'll have you back on again, David, in the future. But this was super enlightening. We'll add some collateral material, some great things for people to browse over, read, and things like that to get more education on portfolio construction. And maybe in our next episode, let's talk about whether a person should look at individual securities or whether they should look at mutual funds or managed accounts and those types of things.
My pleasure, Dean. I'd love to.
All right. Thanks for being here.
Thank you.
So that was David Mitchell with AllianceBernstein. And as I said a moment ago, get to the show notes, check out the collateral material on how to construct a portfolio. Find the show notes, links to resources, and show transcription at guidedretirementshow.com/17. That's guidedretirementshow.com/17. There are also other programs that we've done, other episodes here on the Guided Retirement Show that I encourage you to check out, whether it's the one where we talk about investing in ETFs versus mutual funds, how do you put proper portfolio construction into context for your own personal financial plan. A lot of great information on all the different episodes of the Guided Retirement Show. Make sure you share this episode with your friends. Make sure you check us out on YouTube, subscribe to our YouTube channel, and you can watch us as opposed to just listening to us. And as always, thank you so much for being a part of the Guided Retirement Show.
Investment advisory services offered through Barbara Financial Group and SEC registered investment advisor.